1, 2, 3. There we go. There's audio. Hello everyone. How you doing? Just make sure that the audio comes through on here. And hope you're having a great day. And hope you're excited for this live stream where I'm going to be doing a portfolio roast. So I've just been checking that there's no personal details. If there are personal details, it's kind of on the guy that sent this to me. But yeah, one of the guys in the Discord has sent me their portfolio. There we go. There's audio. Proof. Hello. Cool. So yeah, I'm gonna look. If someone sends me, one of you sends me your portfolio on Discord, what I'm gonna do is gonna do a live stream, and we're gonna try and create a cool format for this, a way to review it. But in this one, I've not had the chance to look at the portfolio yet. I'm gonna be looking at it live. I want you guys to have my first reaction. I do want this to be educational, but at the same time, I just want it to be my honest thoughts on a portfolio. So there's a decent chance that I will learn something about how you guys invest as well. You know, I've only been doing investing a decade, so which is long for some people, and it's no time at all for others. So, right, so almost a decade, 8 to 9 years. Right, so let me share the screen. And there it is. And so this is page 1 of the portfolio. And what I've just done is I created a PDF, and I'm going to start pumping this data into the PDF. So he's got an ETF. So the ETFs, Vanguard S&P 500, 100%. And he has 2,390 in that. So let's go asset, or let's go security. S&P 500 QTY, and that is 2,390. 2,390. Let's get the pennies in. 16. Cool. And now, so looking at that, and it's accumulator, so that's already a good point. That's already a point for you. I'm assuming that you're a younger chap, but either way, if you're getting the S&P 500, definitely, I think, personally, I prefer getting the accumulator. That's where they automatically reinvest the dividends. So that is a good thing. It just means that you get taxed less and that you acquire, like you want to be buying the shares anyway. It just means it happens more by autopilot better. Right, next is UK dividend and UK growth. Does he have these broken down? Yes, he does. God, this is very well broken down. Now, I don't have the full list of what's in the UK. So this is a UK dividend portfolio from the looks of it. It's a pie. He's got the holdings value is 2020.83. 2020.83. Quantity is probably not the right thing to write there. Is it worth writing how much these are up and down? I don't think it has a particular impact. UK growth is not doing very well though. Sad for the 𝗟𝗏cy Sunak. So yeah, you got 2,390. So you got 2020.83 in the UK dividend. Any indication of how much dividend they are giving you? The actual dividend is 21% on that. GSK. Okay. I'm not sure what actual and target stands for. I've not used this app before. So value. It's quite cool the way that this app breaks all these things down. I think it's Trading 212. I have downloaded that app. So be interesting to know, is it Trading 212? 9 investments in this one, and I quite like this 𝗏𝗏 thing. So I heard about the 𝗏𝗏 thing, and I heard that was on Trading 212. I used to hold National Grid. I don't anymore. It's going to be very hard to value your portfolio by valuing each of these, like trying to value the UK dividend pie. But so I'll keep on adding these pies in. So the final thing is UK growth. That's 72.6. So UK dividend pie. I think it's cool that you've done a UK dividend. You're using these pie things. I think the pie things are way better than ETFs. UK growth. ETFs, like there are ETFs that I do not like there's ones on eToro, and they don't tell you what assets are in them, and so they're just called like wheat and oil and stuff like that, and I'm just a bit like, what am I actually buying here? I don't have a firm grasp of what I'm buying, because let's say you're buying a barrel of oil. When you're buying oil, it's just a case of like more research needed. I'm sure there's a way to value them, but I know people, I've met popular investors from eToro, and I've asked them, how do they value wheat and stuff like that? And they just give me some spew about macroeconomics, and they don't actually know what's inside these ETFs. So they're basically saying that they can predict the macroeconomic environment, and I think that is just an absolute joke. But I won't mention names. Some of them are really smart people, but I don't really understand why they're going for ETFs where they can't understand what's inside them. That's what's different about the UK dividend pie here. You can see exactly what's inside it. It's a clever way of diversifying. If you don't, you can think less by each position, because there's a chance that your risk will be reduced by spreading it across various things. It's a clever way of getting a dividend portfolio together. So let me go. UK growth is only 72.60. 72.60. And let's just make sure these are in pounds, aren't they? So let's put this spreadsheet settings, not United States, United Kingdom, not Welsh, calculation, save and reload, and just put that into pounds. And so let's go to the final thing, UK growth. What's inside there? Okay, so for now, that's just EasyJet. So I'm just going to put UK growth as EasyJet, and I actually used to hold EasyJet, but I actually sold before a bit that dip. I think it already dipped a bit, and I just didn't necessarily like. I do like EasyJet. I love the company, but I didn't like the business. I thought I liked it during the pandemic. I thought it would come out financially cleaner than it was, and just basically too many things were happening. I'll do another valuation of it in this video, because it's you created your own pie for it, and I assume you're going to be adding other things to that pie. So I'll do a little bit of an analysis on that. So your top 3 holdings right now, as a result of everything you've done, are Vanguard S&P 500, Legal & General, GSK, and actually you don't have any positions larger than 10%, which is a good thing for diversification. So that's, I'm bad. We'll see how it works out in the long run, but I typically have positions between 10 and 20%, because I go very bullish on certain things, but it can be much, much better to actually have 10% positions, and you don't have too much going on here, which is good. So let's just say, Vanguard, I'm just going to write that down, top 5 positions. Actually, let's just screenshot it. Screenshot that and put it in here. Let's give it its own page. So, top positions. It's annoying. Image, can I paste it there? Cool. And this is going to be portfolio. So dividends. You got £45 in dividends. So let's just write that down. That is cash now. 45.89. div/cash. So that is cash that you need to reinvest, it would seem, unless it's already been reinvested. And then that's the EasyJet thing that we had before, and that we had before. So I'm just going to go to the Discord app to check that I have opened all the images. Yep. UK dividends. He's been, so okay, interesting. He's been investing £500 a month. So the person that sent me these screenshots has been investing £500 a month for 9 months. And here's the percentage of total, if it helps. Okay, cool. So we actually have a pretty decent breakdown, and we know exactly what he put into it. So he put £500 in for 9 months. So I can work it out. I think it's 4,500, but let's just see. Oh, I just added them together. 4,500, cool. So we can do sum here, total equals so you are up £29, which is great. And so what we can do as well, I just want to see what your overall yield is so far. Let me just think. So that divided by that. That is wrong. That should be percentage. So you've made about, you've not made 100%. Anyway, you've made £30 on your investment, which is pretty good going for your first 9 months. You've definitely gotten a bit, there's a bit of luck there. So let's think about these top positions. First, let's do the S&P 500. There's only one real way to value the S&P 500, and that's the 𝗟𝗂. And so the 𝗟𝗂 multiple, is this up to date? Online 𝗏𝗏𝗏. Earnings per share PE ratio. The 𝗟𝗂 PE is what takes the earnings of the last 5 years and creates an average, and then you get a price to earnings that is not as volatile as the single year price to earnings. And it's generally a better indicator as to whether the S&P 500 is overpriced or underpriced. However, there are caveats that we might want to expect a higher PE, a 𝗟𝗂 PE, going into the future, which I'll get into in a second once I find the 𝗟𝗂 PE ratio for the S&P 500, the most up-to-date one. Okay. God, why does it? Everything needs me to like log in and stuff these days. Okay, so as you can see, during the year 2000, the 𝗟𝗂 PE was skyrocketing, and this was the dot-com crash. And a lot of the greatest investors of all time, I think Benjamin Graham was alive back then, and he sold in the 2000s. I might be wrong on that, but it was someone like Benjamin Graham who Warren Buffett took a lot of his philosophy from. And yeah, and then the 𝗟𝗂 PE crashed. And now the red line is Guru Focus new metric called the excess cape yield, or EC-wide introduction, Dr. Robert Shiller, to give more precise picture of the stock market. Anyway, so the all-time historical average of the 𝗟𝗂 PE is 17.4. And right now we are almost double that. So we are due, anyone investing in the S&P 500, it's a bit dangerous to have your entire portfolio invested in them at the minute, because the all-time historical average is actually still quite high. However, one of the reasons that we need to think a bit differently about the PE, I believe what we can expect is the all-time historical average of the 𝗟𝗂 PE to get higher over time, especially as humanity gets better at becoming more productive. And that's what's happened since the internet. So now someone can create an idea, and that idea can compound until it reaches 7 billion people. And during that process, there's a whole lot of growth, and you do not have very expensive assets relative to the amount of earnings. So Microsoft can create a supercomputer system in a warehouse in Texas and then export AI to the entirety of the world, and they can do that in a month. And so with that comes explosive growth, and the fact that they can deliver it to so many people so easily is one of the reasons that we should expect the Shiller PE, or the average all-time PE ratio of the Shiller PE, to be higher going into the future. It's no guarantee, obviously, and we're absolutely going to experience moments of extreme fear in the stock market, we've had some extraordinary 25-year periods. But what we had in the 1930s, where the S&P 500 dropped 83%, I think it was 83%, in 3 years, it can absolutely happen again. So we have to be concerned that about these things. It took 15 years to get from the peak of, I believe, 1929 back to where it was. And so that is the thing that we've got to be aware of. However, accumulators, S&P 500, and that's what you've been smart about, is you've got an S&P 500 accumulator, you will actually benefit potentially. So long as the companies issue buybacks, so long as they issue dividends, you will actually benefit from any downturn in the market, so long as you do not need to pull out during that period of time. So one of the caveats of this is that you need of this portfolio would be a good thing would be to say when you plan on actually using this money and how you intend to use it. Is it a portfolio for a house and stuff like that? Do you intend to buy a house in the next 5 years? In which case I suggest you'd want more cash. But anyway, so we've got 4,000. Let's just put this all into a little pie chart. Insert chart. Now, S&P 500, that's 500 different companies there. Be interesting to see how much of that is Apple and stuff like that. But then, so one of the biggest parts of your portfolio right now is Legal & General. So that is currently 9.53% of your portfolio. So let's add Legal & General into here. And let's put it below the dividend pie, UK and General. And it's 9%. How much does that cost? Value, Legal & General, 427.80. 427.8. Now, equals sum this minus this. Now, this is what your portfolio looks like with UK in general. And so let's go to Simply Wall Street. By the way, one of the ways that I get a discount, so going back to the Shiller PE, what I pay for the Shiller PE is 25% less than this because I use Hargreaves Lansdown. So if you are between the ages 18 to 35, you should absolutely be doing this. So age is another factor in this. There are funds. You go to Lifetime ISA and get 25% government bonus with 4,000 if you invest up to £4,000 in the Lifetime ISA, and this is how I buy the Shiller PE. And obviously, so because I'm getting a 25% bonus from the government, I don't believe the government should be doing this, just benefiting the rich. The people that can actually put £4,000 a month into a Lifetime ISA do not need a government bonus, but whatever, you can't ignore it, it exists. You get 25% of your investment. So theoretically, for me, the S&P 500 is 25% less expensive. Which is going to make an enormous impact long-term down into the future. 1,000. If you aren't using this, you are leaving £1,000 off the table for years, which is just absolutely mad. Everyone should be doing this. So I'm going to get an extra 10 grand from the government, which is going to compound between this time. Anyway, absolutely mad, but that's what it is. Legal & General. This is a great site, Simply Wall Street, and I pay for a subscription. So we've got the value. let me just check that the live stream's up and running and all working. It looks like you can see it. Hello. Okay, so it looks like it is deep value and the dividend looks fantastic. The company health looks like we need to investigate the company's past and future. So future is pretty useless tab on this thing. Plenty of companies I've found have a particularly good future, and this tab seems to be very volatile, and so does the health tab. So past performance is what I like to look at. So insufficient data to display revenue and expense breakdown. What I wanted to look at, had we have been able to look at it, and it's a bit maybe that this is a UK business, London Stock Exchange. This is always useful. Earning. So for some reason, their revenue was negative the past few quarters. So I'd want to look into that. I'd want to understand why that is. Quality earnings. What I also wanted to do, what I look for here is how much the capital expenditure is of the business, the day-to-day operations. That's what I like to know first, because then you got an idea of how much their cash supply can support them if their revenue suddenly drops. Right. So this might be why their revenue is down. They looks like they paid off significant amounts of debt. So that will be what I'll be looking for. So obviously when you pay down debt, you lose equity. Usually you gain equity, but they might have used a supply of cash to do this. In which case their cash supply went down and their debt went down. And maybe that was just to do with the fact that interest rates are going up and they wanted to get rid of variable rate debt. This is all speculation. This is just how I get a helicopter view of Legal & General. Does look like they have an extremely consistent dividend up until, so going forward, they've not put anything in here. Stable dividend, growing dividend, and it's 9%. So that is beautiful. Beautiful. So why is that? Earnings, 58% of them are paid as a dividend. Cash payout to shareholders, cash flow coverage. London Legal & General is paying a dividend, but the company has no free cash flows. Okay, that might just be an issue with them collecting data. So management, compensation versus market. Nigel's total compensation, 4.8. Leadership team ownership. Look at that. Okay, recent insider transactions. These guys have been buying a lot of the stock of the business. So that is also very good to see. Okay. So the next thing I would do after having this, it's interesting. The dividend looks good. Employees are going up, so they're still hiring people. All right, just on a call. So yeah, interesting. Legal & General Group PLC provides various insurance products and services to in the United Kingdom, the United States, and internationally. Okay, so what I want to do now, Legal & General. So it's more of a insurance business. Yep, over 50s life insurance. And so the first thing I would do, there's an interesting dividend on this stock. So there's the reward, your 10% dividend. What you want to do, and also the fact that it's a legal insurance company means that it's got a good future ahead of it. What you want to look at is what sinks legal companies, what causes legal companies to fail, and in my experience, the thing that I'm expecting is their insurance payouts. So I've got to look at what the potential insurance payouts are and what other things that could likely trigger it, and how many of those would it cost to would it take for Legal & General to go bust? I'm on a live stream.
Oh, okay.
Sorry. Right, so I'm just trying to find their investor relations page. Okay, I might have to do this on another video, guys. And I might take a little deeper dive into these other stocks for the next call. And if anyone else wants to have their portfolio roasted, had a look at it. I mean, this wasn't much of a roast. I'm just taking a deep dive into it. Maybe I can try and find a way to put a star rating on each of the positions and create an overall rating as to how, as to what I think of the portfolio. So we've got the 2023 preliminary final year results. There's another website I like to use. Let's see if I can get it up in this video. Finance charts. A guy on Wall Street, a guy on value investing subreddit posted this, and it's absolutely brilliant. Here we are, SEC filings. No data available because it's a London company, so it only does American SEC filings. Net income starting line. Okay, so one of the things, so we could look at the discounted cash flow for a start. By the way, margin of safety, it can't calculate it for some reason. So there's a lot I'd have to do to go in here. Trailing 12 month, these are the sort of overview. Discounted cash flow analysis using net income shows a fair value price of around $25 and versus the last closing price of $13. So would appear to have a margin of safety of about 50%. Trailing 12 month net income growth down 62%. So let's just have a look at that. Financials, revenue. So we've got revenue going from 80 billion in 2019 to negative 84 billion in 2022. So this is a big concern. 10% of your portfolio is this company that has gone from having positive 80 billion to negative 80 billion. So I don't understand how that's happened. Let me just see if I can have a quick look at what area you need to be looking into. Total operating expense is the same. Net interest income. To me, it's very concerning that they are paying out such a high dividend when they are an insurance company. So arguably this dividend should be going towards their insurance premiums. Also, I mean, actually high dividend does make kind of a bit of sense, kind of a lot of sense, but Warren Buffett typically would be taking the money and reinvesting it into other businesses. It's called the float. I'd like to know what Legal & General's float is like. But basically the money that's sat inside the business should be being invested in other businesses. So that is actually how Warren Buffett made most of his money, Geico, and he used the float on a really weird company, blue chip stock, and I actually made a YouTube video about it on my other channel, 𝗟𝗂𝘀𝘁cie𝗺𝗋. So look, guys, I'm going to dive more into this and maybe do another live stream. If you want that, let me know in the comment section. Let me know if you've got any questions from this video, and I'll be happy to go into them.